One of the big concerns about the collapse in the Chinese share market has been that consumer confidence in China might be affected, which in turn would cause the economy to slow down some more. Well, so far so good it seems, at least according to the July survey from Westpac, which was taken after the big falls in share prices in June. The only thing I'd say is that the sample size is 1,000 respondents across 30 cities, which represents 0.0003% of the population of those cities and 0.0006, I think that's right, percent of China's entire population, so could be a bit of a sample error there. Anyway, the share market seems to be settling down after the government threw another $480 billion at it yesterday, actually rising today as a result. But the Shanghai share market is rather looking like a money pit for the Chinese government these days. Investors in US and Europe moved on last night and pushed share prices higher, and in Australia today the All Ordinaries Index closed 0.7% higher, with gains led by iron ore miners. AMP went up 2% after the company announced that its banking arm won't be making property loans for investors at all for a while, which is pretty drastic. The rise in iron ore miners' share prices followed a 2% increase in the price of their product today, while other commodity prices went up as well. And here's an interesting perspective on commodity prices. It's a graph of 33 major commodities since 1900, and it sort of makes an argument that they have further to fall because the long-term trend is down at the rate of 1.2% a year, and it's still sitting quite above that. And the peaks, such as the recent twin peaks, are very unusual. But of course, graphs tell you the past, not the future. And finally, the Australian dollar is perfectly still tonight, and that's finance.